to the person who wrote, because keep in mind, an options contract has two parties, somebody who buys it, somebody who sells it or writes it. Whoever wrote these options, and these are a lot of options. I mean, that's a million shares. That's 1.7 million. That's 500,000. That's 250,000. There's another million shares. There's 1.2 million shares. There's another million shares. There's another 1.1 million shares. That's a lot of stock. Is it in the best interest of whoever wrote these options to make damn sure this thing goes out below these prices? Absolutely. That's that whole maximum pain. This was the BITO analysis that I did the other day, and I said I would circle back around and look at it. So a few days ago, once upon a time, land far, far away, call options, they give the purchaser the right, but not the obligation to buy. So you can see not many calls down here. Why didn't anybody buy these 1950 calls? Nobody bought them at all. Oh, what a surprise. Look at this $25 call, 10,000 contracts. God damn. Remember, there's 100 shares per contract. So that's a million shares of this BITO right there. Hey, there's 1.7 million shares right there at 25.5. So somebody had to write these options. And of course, they collect a premium when they write the option. If the price of the asset goes out above these levels, then that means that the person who bought them, there's some incentive for them to actually exercise the option. You know, let's say the market goes out at 26 bucks. So these 10,000, it's a million shares, right? So the market goes out at $26 at the end of today. Ding, 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 ding. This option is now $1 in the money. There's a million shares. So $1 million times $1, that's $1 million. That's just sitting on the sidelines. This option is basically has intrinsic value of $1 million. Is there incentive for that person to exercise the option and sell the stock at $26 into the marketplace and pocket that $1 million? Well, you know the answer to that. It's not rocket science. If the market goes out at $23, is there any incentive to go and exercise the $25 call and buy the stock at $25 and then immediately sell it into the marketplace at $23 and realize a $2 million loss? No, there's no incentive whatsoever. So the point is, if the market goes out below this $25, then these options will expire worthless. So to the person who wrote, because keep in mind, an options contract has two parties, somebody who buys it, somebody who sells it or writes it. Whoever wrote these options, and these are a lot of options. I mean, that's a million shares. That's 1.7 million. That's 500,000. That's 250,000. There's another million shares. There's 1.2 million shares. There's another million shares. There's another 1.1 million shares. That's a lot of stock. Is it in the best interest of whoever wrote these options to make damn sure this thing goes out below these prices? Absolutely. That's that whole maximum pain. If they take the market out below these levels, then what ends up happening is all these people that paid up good money for these options. Keep in mind, this silly thing at one point was as high. Remember Gucci sweater wearers and all those idiots? This thing was sitting at 28 bucks at some point. So this $29 call was basically near at the money. This $28 call was at the money. 27 call, this thing is $1 in the money. 25.5 calls, that's like $3.50 in the money. Around $3 roughly. There's a lot of money on the table here. And you can imagine the prices that they paid for these options substantially higher than what they're sitting at the value now. Why is the value so low right now? Because the stock is way below those strike prices. If the market goes out at these levels, then whoever wrote these options, cha-fucking-ching. Money in their pocket. It's just that simple, folks.